We got time to do the understanding the risk of low-rated bonds, I believe, right?
We do.
Let's jump into that. So some investors are rightly so have started selling stocks, and they're not excited about buying more stocks at this time. Unfortunately, though, it seems investors got used to the high returns. They have turned to low-rated, high-yield bonds. According to J.P. Morgan Chase, issuance of junk-rated bonds and loans hit a monthly record of $240 billion in July. In 2025, $930 billion has been raised through junk bonds and loans, and that to over the one and add to that. I want to add to that over $1 trillion in junk bonds from 2024. There's a major growth in high yield junk bonds, and that's not a good thing. I did go through the 1990 high yield crisis, and it was terrible for people.
Yeah, and when you look at it, a lot of people think they're maybe not taking on that risk because they're not buying individual junk bonds in many cases, but they have been plowing the money into high yield mutual funds and exchange traded funds, again, also known as ETFs. If you dig a little bit deeper, you find some companies are raising money foolishly, like this company called TransDigm Group. I've never heard of them, but I guess they did a huge issuance of nearly $5 billion in a high yield bond in August to pay a dividend to their shareholders. We like companies that pay dividends, but it should be from cash flow, not from borrowing money that then has to be paid back. That could really jeopardize the balance sheet. Yeah, you get a nice dividend, but all of a sudden it's like the company goes bankrupt and now you lost your principal.
Yeah,
that makes sense.
We had to borrow money to pay that dividend. Just raise the debt is what we did. That's terrible. But the other thing I don't like is business development companies are also back in the news again. I don't like these guys. And these businesses have private loans to small and mid-sized companies. Over the 12-month period ending in June, private loan activity increased by 33%. I have similar concerns with business development companies and private credit, which I believe will have a crash sometime in the future and cost investors more money than anticipate. And some people I don't think even know that they're in these business development companies or private equity.
Oh, I'm sure not. I mean, most of the time people just look at yield and they're like, oh, it's just like a bond. There's a lot more to it. Again, if the risk-free rate is 4% and you're getting 10%,
think about it.
There's risk, to say the least. And one thing that we look at is the current default rate on high yield bonds is 4.7%, which is not bad, but it's not good either. If interest rates on the long end were to increase, which I do think is still a good possibility considering the need for government debt continues to increase, well, that could, again, cause interest rates to increase. This could then slow the economy and cause some of these smaller companies that have these high yield loans to default and file bankruptcy, which means investors would lose money. And you have to think about it this way, even if you're in an ETF or a mutual fund, right? If you're getting this, I'm going to make it easy on me, a nice 10% yield, but 5% of the companies go bankrupt, well, now you've lost 5% of the principal in there. So you're not really getting a 10% yield because you've wiped out 5% of the principal.
Right.
That is where things can get very dangerous, and everything is fine until it's not.
Yeah.
And that's where, again, I think a lot of people are maybe naive to this fact that, oh, I'm safe. I'm in bonds. I'm getting this huge yield. You got to be careful in these because you could get blindsided when you least expect it.